Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Welcome, everyone. Today, we'll start by taking a close look at the financial health of a business and how its value is assessed. This overview is crucial for understanding where the company stands financially and identifying areas for growth or improvement. As we go through the presentation, I'll explain the key factors that influence valuation and how a thorough financial check can provide valuable insights to drive better decisions. Let's get started. Every business has an underlying financial reality, but often leaders only see parts of it. For example, revenue might be going up while cash is quietly disappearing, or profits appear strong even as working capital gets out of hand. On the surface, a company might seem stable, but hidden risks like leverage, liquidity issues, or margin declines can chip away at its true worth. This is where a financial health check and valuation diagnostic comes in. It takes complex financial statements and turns them into a clear, organized, and unbiased snapshot of how the business is really performing, how resilient it is, and its actual value. More importantly, it highlights the valuation gap, the difference between what the business is currently worth and what it could achieve if optimized. With investors pushing for more transparency and capital becoming more selective, this diagnostic isn't just useful, it's a critical tool for making better strategic decisions. A well-executed diagnostic goes beyond just compliance or reporting by giving a business a clear, complete picture of its financial health. It combines key elements like profitability, liquidity, efficiency, and leverage into one coherent overview so you can see how all these factors interact. This helps identify specific value creation levers such as improving margins, cutting costs, freeing up working capital, and optimizing capital structure, all of which can be measured and tracked. Using established valuation methods like DCF, EV/EBITDA, and PE, the diagnostic offers a credible baseline for the company's enterprise and equity value. This baseline, combined with the valuation gap, directs management's focus toward the areas where the most value can be unlocked. The outputs are investor-ready, featuring clear dashboards, ratio explanations, and valuation summaries that support fundraising, refinancing, or strategic planning efforts. Altogether, this approach equips leaders with the clarity and confidence they need to make smart, informed decisions that drive the business forward. The first step in performing a financial health check and valuation diagnostic is to gather and organize the financial data systematically. This means collecting the most recent profit and loss statements, balance sheets, cash flow reports, and any accompanying notes. It's important to standardize this information into a consistent format where revenue, cost of sales, and operating expenses are clearly separated. You should also ensure working capital components like inventory, debtors, and creditors are easily identifiable, and that all debt, lease obligations, and interest expenses are fully accounted for. Adjustments to EBITDA should be transparent to avoid confusion. This structured approach lays the groundwork for an accurate and thorough financial analysis. Taking this example from ABC Limited's profit and loss statement, you can see key figures such as revenue, gross profit, operating expenses, finance costs, and profits clearly outlined for 2 consecutive years, which helps to track performance trends and identify valuation gaps. This disciplined process mirrors the model-driven methods employed by tools like shareholder values diagnostic, enabling a clear view of a company's financial well-being. To assess a company's financial health, we calculate key ratios across 4 main areas: profitability, liquidity, efficiency, and leverage. Profitability ratios, such as gross margin and return on equity, show how well the business generates profit from its operations and investments. Liquidity ratios, including the current and quick ratios, indicate the company's ability to meet short-term obligations. Efficiency ratios like inventory days and debtor days reveal how effectively the company manages its assets and working capital. Finally, leverage ratios such as gearing and interest cover highlight the level of debt and the risk of insolvency. These numbers tell a story about strengths and weaknesses, For example, the example company shows stable revenue growth and good gross margin, but areas like EBITDA margin and operating profit margin could improve. Liquidity looks healthy overall, though the cash ratio is low compared to current liabilities. Efficiency measures suggest inventory and debtor days need attention, which affects the working capital cycle. Leverage is within acceptable limits, and interest cover remains solid. Understanding these details helps identify where management should focus efforts to strengthen financial health and support valuation. To build the valuation baselines, we usually rely on three key methods. The first is the discounted cash flow or DCF valuation, which looks at factors like revenue growth, EBITDA margin, the weighted average cost of capital, and terminal growth. This method helps estimate the present value of future cash flows. The second is the EV to EBITDA multiple valuation, where we apply multiples appropriate to the sector to determine enterprise value. Third, we cross-check the equity value using the price to earnings multiple. By using these three approaches together, we create a triangulation effect that gives a balanced and credible valuation range. For example, in assessing DCF, you might see revenue growth increase from 5% to 6%, EBITDA margin improve from 10.5% to 14%, and WACC slightly lower from 10% to 9%, while terminal growth remains steady at 2.5%. These adjustments reflect an optimized scenario that enhances free cash flow and supports a solid valuation based on multiples, providing a comprehensive snapshot of where the business stands now and where it could be headed. This method ensures the final valuation isn't overly reliant on one single metric and instead is grounded in multiple robust indicators. At this stage, we focus on comparing the current state of the business, or the as-is scenario, with an optimized scenario that reflects achievable improvements. The as-is scenario shows where the business stands today, taking into account existing performance and operational limits. The optimized scenario, on the other hand, represents the results we can expect by improving margins, cutting costs, better managing working capital, or reducing debt. We identify the valuation gap, which is essentially the difference in shareholder value between the current state and the potential upside. This gap quantifies how much value can be unlocked through targeted actions. The summary dashboard breaks this down using different equity valuation methods like discounted cash flow, EV/EBITDA multiples, and price earnings ratios, showing the value under both scenarios and highlighting the opportunity for growth. This step is critical because it makes it clear where and how financial performance improvements translate directly into higher business value. The value creation bridge summarizes the main drivers that can uplift the business's equity value, making it easier to communicate the impact of improvements. These drivers include margin improvement, which increases profitability by reducing costs or enhancing pricing, working capital release, which frees up cash tied in operations, cost optimization, ensuring expenses are kept under control, revenue growth, which expands the top line and market opportunity, and capital structure improvements, which strengthen the balance sheet and lower financing costs. When put together in a clear chart showing the value impact of each driver, this bridge becomes a powerful tool to align understanding and support among boards, lenders, and investors by illustrating how different levers contribute to the overall increase in enterprise value. A company experiencing strong revenue growth found that their debtor days had increased, which tied up cash in working capital. By tightening credit terms and improving how they collected payments, they freed up several £1 million of cash. This improved their net debt position and increased the overall equity value. In another case, a services firm thought it was doing well because revenue was steady, but a closer look showed their EBITDA margin had declined from underpriced contracts. By adjusting prices and stopping unprofitable work, they significantly boosted EBITDA and improved their valuation based on the EV/EBITDA multiple. Lastly, a business with high debt looked financially stressed, but when we separated operational results from capital structure, we saw strong profitability underneath. Refinancing reduced interest expenses and helped raise the equity value considerably. These examples show how a thorough financial health check and valuation diagnostic can uncover hidden opportunities to create value. This diagnostic gives you a comprehensive picture of how the business is performing by bringing together profit and loss, balance sheet, cash flow, and valuation data in one view. It doesn't just offer general advice, it puts numbers to value creation, making it easier to see where real improvements are happening. This makes it a practical tool for strategic decisions, clearly showing which areas need management's attention for the best impact. It also builds trust with investors, since the process is well structured, transparent, and backed by solid evidence. Plus, it acts as an early warning system, helping identify potential risks before they become serious problems. The reliability of this type of financial analysis depends heavily on the quality of the data you use. If the financial information is inaccurate or incomplete, the results won't be trustworthy. Additionally, many assumptions come into play, like the weighted average cost of capital, growth rates, and valuation multiples. These require judgment and can vary widely depending on who's making them. It's also important to remember that numbers alone can't capture everything. Operational insights are crucial because financial metrics don't explain cultural or strategic challenges within the business. Finally, this kind of diagnostic is just a snapshot in time. To stay relevant and useful, it needs to be updated regularly as conditions and assumptions change. A financial health check and valuation diagnostic goes beyond just reviewing numbers. It offers a strategic perspective for leaders to truly grasp how their business is performing, how resilient it is, and what its real value is. By integrating ratio analysis, valuation methods, and scenario modeling, this approach highlights both the risks that need attention and the opportunities that can drive significant value growth. In today's world, where understanding your financial position clearly is crucial, those businesses that know their numbers best are positioned to create the most value and make more informed, confident decisions. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.